Hey guys, welcome back to another video. My name is Josh, and in today's video we'll be discussing all things Gentailers. In particular, we'll be taking a look at Meridian as well as Contact Energy, some of the news around these two stocks which have caused, the share price to go up recently, as well as the news announced today on the Tiwai Point smelter opening up until 2024. I'll also perform an intrinsic value calculation on these two stocks, and this obviously is based on my opinion and my own assumptions, so do take that with a grain of salt, but I think you will find some of the results that I found quite interesting, so be sure to stay till the end of the video. As always, this is not financial advice, purely for entertainment purposes only. You can read the full disclaimer in the video description down below, but without further ado, let's get right into it. So just taking an initial look at the share price movement of Contact Energy, the shares are up 31.22% in the past year, and in the recent month the share price have gone quite ballistic, all the way up 29.67%, up to $10.75 before retracing down 10% to currently $9.75 as of recording. Likewise with Meridian Energy as well, in the past year has experienced quite big growth, up 53.98%. In the past month, their share price went up to 43.95%, up to a high of $9.40. Down currently 16% from all-time highs, trading at $7.88. So as you can see, if you've invested in these Gentailers 5 years ago or when they IPO'd, you would have done quite well. You would have 3 times your money. So if you put in $1, you would have made another $2. So needless to say, really good results for IPO investors. And now a lot of people are wondering whether these stocks are now overvalued because they have gained so much in the past year or so. So we're going to go through some of the news that has happened. But before we do that, I need to give you guys a little bit of a history lesson in case you are quite new to the stock market or you weren't aware of what was happening mid-2020. So I want to bring you back to this small dip over here. So this small dip over here, a drop of roughly 10% in one day for Meridian Energy, and likewise the same thing that has happened for Contact Energy, roughly 14% drop. That was initially because Tiwai Point smelter announced that they were going to close in August 2021. So on Thursday, Rio Tinto, which is the majority owner of the Tiwai Point aluminium smelter, announced that it was prepared to close in August 2021. Now, the Tiwai Point aluminium smelter essentially consumes roughly 10% of New Zealand's electricity supply. They are located in the South Island, with Meridian Energy being the lead supplier. And Contact Energy supplies Meridian Energy some of the power to supply to that Rio Tinto smelter plant. So if Rio Tinto smelter plant were to shut down, then obviously Meridian Energy and Contact Energy would have the highest exposure, and therefore that's why their share price have dropped so much. Fast forward since the drop, the share price went on a monster rally all the way up to 108% up from its lows in July, and likewise Contact Energy also had the same monster rally, up 73%. Now, the reason for such a monster rally for both of these two stocks is because of an inclusion in the Standard & Poor's Global Clean Energy Index, with firms in that sector finding more favor with investors following Joe Biden's election win in the United States. And you can see here in this ETF, the Ishares Global Clean Energy ETF, you can see that they actually hold quite a high number of Meridian shares, as well as quite a high market value, right? So they hold 54.7 million shares in Meridian Energy, and then you can see Contact Energy as well. They hold roughly 39.7 million shares. Now, the impact of these ETFs now starting to buy these Gentailers because they have been included in an index has caused the share prices of these stocks to increase. Furthermore, this was done around the late December period, when markets traditionally have been rather illiquid, okay? Meaning that there's not many people trading on the stock market just because a lot of them have gone on holiday And what this did was it caused the share prices for these two stocks to go crazy, right? And that's why we see such a steep increase towards the end of the year in late December. So today we learned that the Tiwai aluminium smelter will stay open until the end of 2024. The NZAS, or the NZ Aluminium Smelter, issued a press release on Thursday morning, so today as of recording, saying it had reached an agreement on a new electricity agreement with Meridian Energy that allowed the NZAS to continue operating the Tiwai Point aluminium smelter until December 31st, 2024. So obviously this is going to be good news for both Meridian Energy as well as Contact Energy. But if we look at the share price today, Contact is down roughly 2.11%. Meridian is also down roughly 0.25%. So you can say that the news has already been priced into the share price, or that potentially that the stocks have just gone up so much that any good news around the NZAS wouldn't have that big of an impact on these two share prices. So that brings me to the intrinsic value calculation. Now, the first steps that I took when performing my intrinsic value calculation was that I took the historical data from Reap. So you can check out the Reap app, link in the description. Not sponsored, by the way. So what I did was I took the free cash flow numbers from the Reap app for the past 5 years. I also took the total dividends. Now these total dividends include special dividends, which management has said in their most recent annual report that they won't continue going forward. So what I did was I stripped out the special dividends to calculate the ordinary dividends, because ordinary dividends are likely to continue going forward, whereas special dividends tend to be a one-off thing. I then calculated the shares outstanding. You can find the number here from the NZX website, the current market cap as of closing yesterday, just because, you know, prices can move up and down today. So I won't bother with that. I just used last night's numbers. And I calculated the current free cash flow multiple. So what I did was I took the free cash flow for FY 2020 and I divided that by the market cap. So that's sort of like the PE ratio, but instead of using earnings, so that's net profit after tax, I'm using free cash flow. And what I did was I also took note of their dividend policy, which management have said that it would be roughly 75 to 90% of free cash flow. So next, I worked out my bear case. So in my bear case, what I did was I forecasted a growth rate of 5% for the next 4 years. And the reason being is that the worst case will probably not do as well as what they're doing now. To discount for that, I decreased the growth rate by 5%, whereas, you know, the compounded annual growth rate for the free cash flow for the past 5 years was roughly 8%. So to be conservative, to price in a bad case or a bearish case, I use 5%. And then for the next 5 to 10 years, I use a 3% growth rate. So that is at 2025 onwards that I use this growth rate here. And the reason being is because of the Tiwai smelter point shutting down in 2024. So we expect a slight decline in 2025 earnings going forward, as well as over time, you know, as the company grows bigger over time, it will be harder for the company to increase their earnings because they are working off a larger base, okay? And also, this is a Gentailer after all, a power company. It doesn't have a significant amount of growth to it, okay? And then what I did next was I calculated the dividend policy. So the dividend policy is essentially how much they are currently paying out of free cash flow. So the net dividend that they paid was 16.9 cents. I calculated the dividend policy, which they're paying out roughly 80% of free cash flow. All right, so over time, I expect the company to increase their dividend policy all the way up to 90%, increasing by 1% per year, so that it ends up in the upper range of the dividend policy of free cash flow. And then I calculate the dividend paid, and this is the imputation credit. Now I got the 86% imputation percentage from their most recent investor presentation. And what that means is that for every dollar, you can only claim the full tax benefit for 86 cents. So what I did was I forecasted 86% just for simplicity's sake going forward into 2030. Now, this might change obviously, but this is just a high level intrinsic calculation, so I won't go into too much detail. And then I calculated the gross dividend paid, including imputation credits. I calculate the tax impact as a individual receiving it. Now, I've used a 33% tax rate because I assume that you'll be earning between $70,000 and $180,000 going forward into 2021. And I calculate your after-tax dividends because this is essentially cash going into your hands. And I discount that cash with a 10% discount rate, giving me a present value of 14.6 cents. Now, the discount rate that I use for this model is 10% because 10% is higher than what index funds have usually returned over the long term, which is roughly 7 to 8%. So if I'm picking individual stocks, I do want a higher return, so I have used a discount rate of 10%. And then I do the same for the remaining 9 years. And I also calculate at the end of 2030 a terminal value. So essentially this terminal value is if I sell the shares at the end of 2030, how much can I expect to receive from it? And the number that I came up with is a terminal multiple of around 20 times free cash flow. Essentially, this 20 times multiple is what I think is reasonable if this company is only going to grow at 3%. However, this is a blue chip stock that can pay me dividends. So 20% seems reasonable given the current interest rate environment. This gives me a terminal value of $6.12. Obviously, I have to discount that number, and that gives me a present value of $2.36. You add that all up, this gives me an intrinsic value of $3.57. So essentially this tells me that going forward, all the dividends that I can collect and later on sell this company, today it is worth $3.57. Okay, this $3.57 is not the value 10 years later, it is the value today. Now, I repeat the same thing that I do, but I adjust the growth rates as well as the terminal multiple for a normal case. So obviously, for the next 4 years, I just maintain the same 8% growth rate for the normal case. And then I also calculate a slight decrease in the growth rate from years 5 to 10. And because this company is now growing at 5%, I can give it a higher terminal multiple. And this gives me a present value sum of $5.09. With the best case scenario, I adjust the growth rate again to 10% for the next 4 years and dropping down to 6% for years 5 to 10. And as well as that, I also give it a terminal multiple of 30 times, which gives it a present value sum of $6.35. And then what I did was I assigned probabilities to each of these scenarios, 25% for the worst case, about 50% for normal case, and a 25% probability for the best case scenario. And what this gives me is an intrinsic value of roughly $5.03. Based on yesterday's closing share price, that means that the share price is currently overvalued by roughly 36%. If we look at the chart for Meridian Energy, what we can see was that the share price of roughly $5 happened just before that monster rally occurred. So that makes sense to me because the monster rally that has happened is because of non-fundamental issues. It's basically just ETFs buying up shares, okay? Nothing has changed within the business. And if you backtrack a few months ago, the share price was roughly around intrinsic value based on all the future dividends that you can receive and later on sell the company after 10 years, all right? So that makes sense to me. And at the moment, Meridian Energy does not look cheap at all, in my opinion. A lot of the future growth has already been priced in. Now let's take a look at Contact Energy's valuation. Contact Energy was a little bit harder than Meridian Energy because, as you can see, their free cash flow was a bit lumpy, okay? So it does show that the earnings quality of the business isn't as good, and CAGR, compounded annual growth rate, was actually negative 15%. Now, looking at the annual report, the Contact Energy CEO did say that in the first half of FY20, there was a sharp increase in thermal input input cost, which has caused free cash flow to decline. They also attribute the decrease in free cash flow due to a global illness as well. And they also said that, FY19 was a really good year because they had highest wholesale prices and stronger hydro generation. So what I did then was I built that into my expectations. Assuming the worst case scenario, what I did was I just grew it from last year's free cash flow, from FY20's free cash flow. I used lower growth rates here than in the Meridian worst case, just because Contact Energy does look like it has poorer quality of earnings, and so I do use lower growth rates just to be more conservative. I also said that their dividend policy is roughly 75%, and the reason being is because if you look here, they did say that their dividend policy was under review because of structural changes around the business. So they needed to make decisions around how they would optimize their asset portfolio, especially the TCC plant. Now, the TCC facility is a combined cycle turbine plant, and that plant runs on gas. So in this article here, it said that problems at offshore fields lead to reduced natural gas production. Contact Energy has been told its allocation of gas from the offshore Maui and Pohokura fields will be cut by 3.7 petajoules to 10.6 petajoules for the next year, down about a quarter on its supply for 2020. So what that means is that the prices of gas, which is an input cost into the plant, will go up. So what this means is that management will probably have to be more conservative with their dividend policy as they navigate through this period, which is why I did assign them a lower dividend policy compared to Meridian starting at 80%. So I assigned 75%, increasing 2% every year, hitting a target of 90%, as over time they will have more cash flow certainty to pay out that dividend. And I repeat the same activity essentially. I do assign a lower terminal multiple rate because the company is growing at a slower rate than Meridian Energy, and that gives me an intrinsic value for the worst case scenario of $4.62. For the normal case scenario, instead of just growing free cash flow next year based on this growth rate over here, what I did was I used a weighted method. So essentially what I did was I said, all right, maybe they can meet somewhere between these two numbers in free cash flow. So it won't be as bad as 2020, but it won't be as good as 2019. So I assigned a 75% weighting on 2020 free cash flow and a 25% weighting on 2019's free cash flow. And what this gave me was a number of roughly 38 cents of free cash flow per share. And then I grew that out by 5% for the next 3 years, and then going into 3% growth rate for 2025 onwards. And I also used a terminal multiple of 22 times, which gave me a present value sum of $6.73. And for the best case scenario, what I did was I increased the weightings a little bit more evenly. So what I said was free cash flow would be roughly in between FY19 and FY20. So I assigned a 50% weighting on both of these numbers, and that gave me a free cash flow per share of 44 cents. And then furthering on, I did grow it by 8% until 2024 and 5% for years 5 to 10. Using a higher terminal multiple of 25 times, that gave me a present value sum of $9.40. And assigning the same type of probabilities as I did for Meridian Energy, this gives me a intrinsic value of roughly $6.87. Current share price based on yesterday's closing is $9.95, which means that the share price has to decrease roughly 31% for it to go into my intrinsic value. And if we look at the Contact Energy share price, it is the same story as Meridian Energy. The share price was roughly at intrinsic value before that monster rally had occurred. So what this means that if you're looking to buy at the current price, it does seem a little bit high, and a lot of the growth does look like it's already been factored into the share price. And that makes sense because the increase in share price was nothing fundamental. It was purely a ETF event driven issue. So what's important to note is that this could continue going forward into the future, you know, could go on for the next year or so. So these two stocks could be overvalued for quite some time because of ETFs buying into those positions. However, what this means for investors like us, retail investors, we can actually just not buy these stocks because we don't have to. And personally, I do think that the future returns of these stocks won't be as high as what it was in the past, just because there's been so much demand for these stocks that the valuations are out of the window, right? Everything just thrown out. Let's just buy these clean stocks because clean energy is the future, right? But for value investors, definitely this is a huge red flag. Valuations does seem high, but as I mentioned before, this could continue on going forward. So that is my take on the Gentailers and where they are currently trading at. I did leave a link to the spreadsheet, so if you want to adjust any of the numbers that I have on the spreadsheet to find your own intrinsic value and maybe adjust the discount rate, for example, if that is something that you're interested in, be sure to check out that link below. So please share this video with someone who you think will find it helpful. If you enjoyed today's video, be sure to hit like as well as subscribe. Thank you for watching this video. Until next time, take care. And now a lot of people are wondering, are these two stocks currently overvalued because of such a meteoric rise?